Welcome to a special video. Today we are joined by Quai, and representing Quai is Dr. K. Dr. K, you are one of the founders, builders. How do you identify yourself in relationship to Quai?
Yeah, so I'm a co-founder, and I'm kind of the CTO of the development company Development Strategies, and I'm really the one that started down this path of building a scalable proof of work.
Yeah, so this is a kind of big. Now, guys, I know you may not know what Quai is. Maybe you do. It was kind of big in like the zeitgeist, and it's making a comeback. Quai is re-attacking, maybe attacking a new way, the like proof of work, proof of stake, proof of, you guys have proof of entropy minima dilemma or trilemma in this case. How are you guys, well, what's your approach to chain security? What is Quai?
Yeah, so Quai is a scalable proof of work EVM-compatible system. We use a hierarchy of merge-mined blockchains that allows us to shard and subnet a proof of work system, which allows us to get scale north of 50,000 transactions per second.
Okay,
so the
now,
real
before
goal
we
here is
move forward, we need to bring this back down to like a 5-year-old level. What is sharding? It's a big buzzword, especially in EVM land. How does it apply to anything?
Yeah, so when we talk about scaling and just scaling like basic systems, like a database, Facebook, whatever you will, this concept of sharding comes up. And basically what it is databases effectively have a certain read-write speed that you can put through them. So if the system scales beyond that read-write speed, you create sort of instances. Now, the like multiple instances of the database, but the problem is you need to then also sort of shard what data goes into those instances. So in the case of Facebook, you might say everybody's data, who has names A through M are in sort of the first shard and N through Z are in the second. And then when they go to sort of access the system, they know, oh, I should go to shard 1 or I should go to shard 2. And then as the system grows, you can keep further sharding those systems with scale. So this is sort of a common technique that's used with databases where when one database is not enough, you kind of separate your data into many databases. Now with blockchains, you have an extra piece on top of this, which makes this especially difficult, which is you have to maintain consensus amongst those shards. And so consensus isn't something you can truly shard because you ultimately have to have one sort of canonical understanding of the system, ledger, and agreement. So although you can separate the data, you then have to have a robust consensus mechanism that sort of allows you to say what you think the canonical state is of the aggregate system at any point in time.
So you need like one, what do they call that in philosophy? You need a single source of truth, like ledger, that has all of the everything on it that people can refer to as a true referent of the data. And then the shards, how do they assist a network if you still need a single source of truth? Like what benefit are they adding by existing?
Well, it allows you faster sort of read-write access, if you will. So you can increase throughput, i.e. in blockchains, transactions per second is a decent proxy by having shards. And then your consensus mechanism has to be able to sort of deal with that. So you need a novel consensus mechanism relative to what has previously been proposed.
And so previously, the consensus mechanisms are proof of work and proof of stake. Is that accurate?
Yeah, I think that's the majority of them in the short form. And it's everything is pretty much a variation on those two. Yeah.
And you guys are what I would say a variation on proof of work. Is that also correct?
Yeah, I would say that is right. So the actual mechanism by which we're sort of economically finalizing the chain is proof of work, but we have a different mechanism for weighing it. So sort of figuring out what truth is and sort of how to assign value to each block or chain in terms of weighting which one's the canonical tip.
Now, proof of work blockchains, I mean, Bitcoin still exists, certainly. We have a few other proof of work blockchains that are sort of competing in their own niche. You guys have tried to do something entirely different than I think any other blockchain has, which is, we'll get into the stablecoin you guys have here in a second, but my understanding, my very, very shallow understanding of what Quai is an attempt to tokenize compute or hash or energy in some meaningful way to have an asset that is backed by some sort of robust ephemeral value.
Yeah, so there's actually two tokens in our system, right? There's Quai, which is sort of the traditional deflationary token. It's account-based, EVM compatible, but it sort of has a Bitcoin-like emissions, if you will. The other token is Chi, which is the one I think you're describing, which we call the energy dollar, which is an attempt to effectively tokenize hash, which is then a proxy for miner energy costs. So the idea there is you can create a stablecoin like alternative that's really sort of some form of a flat coin whose value is related to energy, and then ideally whose purchasing power is relatively consistent with time, is really sort of the I guess, summary. The reason you want to do that is our sort of thesis is you can't have an independent cryptocurrency or an independent decentralized system if the majority of that value that's circulating on that system is some form of a fiat referenced or fiat backed stablecoin. But what the market has clearly showed us recently is that about 70% of transactions by value happen in stables. So the concept of having a unit of account is very, prescient in that the market sort of demands that you need it through their expression of what they're using. So if you want to create a decentralized system that, continues to be decentralized, you need sort of this endogenous unit of account in the system so you're not still dependent on dollars.
So there were a few things you said there that I want to make sure that we hash out, no pun intended, before we move on. One, you said this is more like a flat coin than a stable coin. What is the difference between a flat coin and a stable coin?
So a stable coin is something that, has a peg to an external reference. So that could be a US dollar, that could be a euro, that could even be like an ounce of gold, but it's sort of strictly referenced. A flat coin is something that references an index or physical good more directly. So specifically with the system, right, what we're saying is in the design, we're creating a unit of electricity, but it only sort of represents that price in market equilibrium. So there's no sort of like guarantee here. There's no peg. You can't like take a Chi and redeem a Chi for like 10 kilowatt hours of energy. But what we're saying is in the market design, the market price of Chi over time should track the value of, say, 10 kilowatt hours of energy. So it's not pegged, it's not sort of redeemable, but it's designed to follow. But it's the market that does the following. It isn't some sort of like trusted custodian that's giving you redemption for that value.
So it has a referential value, but not an NAV.
Yeah, that's right.
That's right. So in this case, you have the two assets, Quai and Chi. One of them is trying to follow that referential value of hash. The other one is performing a different function relative to the proof of work mechanism. So in a proof of work mechanism, right, you have miners. Miners are, I would say, validating, I'm sure there's a better word, hashing transactions on the ledger. They're the ones who are saying, like, we agree, this is a valid transaction. Let's smack that onto the ledger, and then we get reward for it, each block. That's the miners, but you guys have a very specific mechanism for rewards with Quai. So one, it's kind of exciting that proof of work is making a comeback, that you can get reward and paid for proof of work. I think a lot of people miss their mining setup. And then two, it's not just difficulty. Can you sort of explain how Quai works? And if there's any visual you want me to pull up for this one, let me know.
Yeah, let me see here a second. So this would be page, yeah, you could go to 23 maybe.
I'll scroll all the way there. Okay. There we go.
Yeah, so the way that this works is Quai is meant to be sort of like your store value, your sort of Ethereum or Bitcoin analog. So, it's the EVM-compatible account system. It's programmable, and its rewards are proportional to the binary log of difficulty over time. So sort of as difficulty goes up, the emissions per block go up, but they go up at like a very slow rate. So the actual sort of value per block then, as the sort of difficulty doubles, you can effectively say the value of Quai has doubled. If
there's a reason for this. The value, so like, is this analogous to Bitcoin? As the difficulty for Bitcoin increases, does the value for Bitcoin also increase relatively, or is this unique to Quai?
So with Bitcoin, on a very long time scale, that statement is true. On a daily time scale, because of the fact that the emissions are fixed every 4 years and then do a halvening, it's not true. So that's one of the reasons you get sort of like booms and busts in Bitcoin, is because the stock to flow changes because the market is adjusting to sort of this arbitrary time-based emission cycle. What we're saying here is that we're continuously adjusting to that cycle. So halvenings basically happen as the market demands halvenings to happen.
So it's a function of supply. Is that more or less correct to say?
Emissions is a function of the market's willingness to value Quai, effectively. Okay. So, and that value representation is then manifest in the hash rate. So as the hash rate goes up, the emissions of Quai goes up, but it goes up much more slowly than the hash rate. So as that's happening, you're basically saying the value of Quai is increasing as more people are willing to mine it.
And now, what is a hash rate? So you say as the hash rate increases, is hash rate just difficulty? Is that synonymous, or is hash rate
they're
something else?
Yeah, they're roughly synonymous, right?
Okay,
so difficulty is just saying sort of the like mathematical criteria that you have to meet to find a block, but that is proportional to the total hash rate in the system.
And hash rate increases when there's more demand for mining Quai.
Yeah, that's right.
And that's demand specifically on mining Quai. If there is, let's just say, buy side demand, so market demand for Quai, is hash affected at all?
Yes. Yeah. So this
is unique to Quai, and not because that's not true for Bitcoin, right?
So it's less elastic in Bitcoin. It is also true on a long-term basis, but because Bitcoin is ASICs, the supply of compute is much more inelastic in terms of time. But when you're using GPUs as your mechanism for doing work, you have pretty good elasticity in supply. So if price goes up, people find compute to hash rate because there's money to be made. And if price goes down, they take it off.
Okay, so there is always a relationship between price and hash rate, because if Bitcoin skyrocketed and hash rate didn't change, then people would just be mining for way more profit. And so because there'd be more mining activity, hash rate would increase to meet the difficulty of the more or to meet that new demand for hash. Likewise with Quai.
Right. But the big difference there is GPUs and ASICs. So there's a ton of GPUs in the market, right, that do different things at different price points. And so if the price of Quai goes up a ton, then GPUs find their way onto the network because there's money to be made. And then the more profitable it becomes, the more incentive there is for those GPUs to come and mine.
So do you think that Bitcoin and or proof of work and or Quai type mechanisms were one of the reasons why we had so much advancement in graphics cards?
Before AI hit the scene, there was definitely a couple cycles that 2017, 2018 drove NVIDIA's stock price. So that palpably, had an effect on the development of cards. Absolutely.
And so with Quai, you keep referencing, I think you said ASICs. How is Quai different from the proof of work using graphics card miner than other proof of work blockchains?
Yeah, so we use an algorithm called ProgPow, programmable proof of work, and it's designed to remain sort of GPU friendly. So sort of the way it was designed was to say, if I were to have an ASIC and that ASIC, quote unquote, looked like a graphics card, right, what algorithm could I make to make sure that all parts of that graphics card are utilized? So the algorithm is basically designed into the hardware, if that makes sense, rather than designing an algorithm that you could then design hardware specifically for. You basically designed the algorithm to match a type of hardware, which was a GPU. So with that, it sort of remains GPU friendly because it's designed to be on a GPU. And so what that means is that for miners, you have a much lower cost of entry. So a lot of hobby and boutique miners sort of can have access to the system. And you don't sort of have the same sort of centralizing control that you get with ASICs, distribution, etc. One thing that we thought about when picking the algorithm was, at some point when Quai is successful, if it challenges nation state currencies, nation states, some of them will decide that they don't like it. So if you look at sort of the ability to import export GPUs and limit the import and export of GPUs, that's actually very hard, but it's very simple for an ASIC. So if a country said they don't want you mining Quai and Quai was on an ASIC, they could just stop all access to ASICs in a country pretty easily.
And how is that? Just because of the input of the graphics card itself? Like there's a physical blocker, or could they block it programmatically? Or
No. For GPUs, they can't block it. Is my point. They can't block the physical movement of it. They can't block anything. But for ASICs, they could be like, oh, look at the port. Here is an ant miner for Quai. Don't let that through the port, right?
But graphics cards, because they're effectively used ubiquitously in any sort of computers, it would be harder to prevent the input of graphics cards unless you were to say no more computers for our civilization.
That's effectively the statement you'd be making,
right?
Yeah.
Okay, so with Quai mining, and we're gonna get to like the relationship between Quai and Xi shortly, because this is like I think the meat of what makes this blockchain so unique. There is, I think the average APR for Quai mining is like 8%. Is this correct? One of like the highest proof of work APRs.
Yeah, I think right now, it's one of the most profitable coins to mine. Yeah,
which is a huge comeback from well, the yesteryears of proof of work. Now, the other thing, I mean, I get excited about composability. There's no surprise there for anyone who's followed me. I want to like wrap everything and then stake everything and then leverage up the wrapped version of this. We are going to see wrapped versions of the proof of work, as far as I understand, which may allow people to participate in proof of work without their own miner. Now, maybe you guys want to incentivize that behavior. Maybe you don't want to incentivize that behavior. For yield farmers, of course, it's really exciting. For decentralizing proof of work, probably not as exciting.
Well, there's one aspect of the system that's not super well known, but it's coming online shortly, or portions of it. So one of the statements we made, right, was that it's GPU mineable, so it's not ASIC mineable, which means you have a lower cost of capital entry, and the sort of supply of compute is relatively elastic. Now, one of the problems with that in a proof of work system is you lose sort of some of the security related to sunk capital investment in ASICs, right? So if you look at sort of the attack on the Bitcoin network, one of sort of the attack criteria they look at is how expensive would it be to get enough ASICs to sort of run the attack. And so the capital cost of the ASICs themselves have to sort of get baked into that cost. Whereas with GPUs, you don't have that capital cost because you're saying that's available to rent and you can just redirect it. So there's this sort of lack of capital stickiness so that you can get sort of that geostrategic resilience of availability, right? So what we did is we actually added into the system what we call locked mining rewards. So when miners are mining currently, they can choose to get the rewards sort of at the normal maturity of the block reward, or they can defer it for 3, 6, or 12 months. And at 12 months, they get an extra 25%. And so what that does is it allows miners to lock up some of their capital for greater reward. So then it makes the system look more like ASICs in terms of attack. Now, if you're talking about what that looks like in terms of sort of other mechanisms in yield, you just created a native staking sort of yield mechanism in the system. Now, the next then problem is miners may not have enough capital to sort of float a lot of their mining rewards for a year. And so what has been built in the application layer is contracts where you mine the locked tokens through a contract, and they basically put it into an NFT that looks like a bond. And then people can just liquidly buy and sell those bonds in the market.
So they've wrapped locked tokens effectively. You have liquid locked assets, but instead of doing like a liquid locker like we see maybe on Ethereum, you're saying it's a liquid locker that's an NFT. So these can be transferred. Well, actually, that also exists in EVM land. So you can transfer these NFTs, which are just like bonds because they mature at a specific date. And so you're purchasing discounted Quai, and this makes the miners' locked emissions liquid for them so that if they need more capital to scale or to grow their infrastructure, they can do that while also maintaining locked assets for the network, which is beneficial for the security.
Right. That's right. So the cost of an attack goes up by having those bonds in the system, so to speak. But then what it looks like from a user's perspective is they can come in and buy yield. So the miners right now can already do the election to lock the rewards. The first application that's allowing you to trade those as bonds liquidly should be coming online in the next week or two.
That's going to be kind of exciting. So I was looking at the network for Quai, and remembering this is an EVM compatible network. it must be one of the another. I think was Dogechain EVM compatible because they're also proof of work. It's one of the first like proof of work chain, but certainly the first proof of. Keep reading the EM poem chains, and so you have your like ecosystem being built. I also love to see Akash on there.
So from the mining conversation, right? If you look at Akash and Chlor there on the first page, they have like single click like mining integrations. So you can actually go, if you want to mine, you just do like a one click and you rent hash rate and it deploys and mines the network.
What would I do?
Click, go to the website. Sorry, the web link. The little globe.
There we go.
There you go. And then if you go to
deploy now,
deploy now, and then should be search for Quai.
Oh, that's cool because Akash is like a decentralized cloud compute, so you could have them deploy the miner for you.
It's the node and the miner. So like you do like a one-click deploy, and then it just mines. It deploys the node and it mines for you.
I think it doesn't like my VPN right now. Incredible.
Yeah.
It's. And I'm sure they use probably more robust hardware than I would have access to as like the lay user. And there is probably some arbitrage between the cost of Akash and the value of the mining rewards from Quai, especially if you're long Quai. If you're using Akash, could you also still do the lockup for 12 months to get that additional 25%?
Yeah.
That's rad. That's cool. Okay, so now like people understand proof of work, I think, to some extent. They at least know like it's a different form of security and like it creates rewards and there's effectively like some sort of APR from using it. Maybe you can use cloud compute. That's way cooler than like, well, actually, no. Cooler is having your own hardware set up, but it's way easier. And it is also cool to use Akash because like decentralized cloud compute, the future. But there is this really novel thing you guys are doing, which is having a relationship between Quai and Chi. Again, Chi being a flat coin. So I was sort of secretly like typing into ChatGPT, like, what is a flat coin? Can you explain it to me? Like I'm a silly person. And they use a really good example of like a flat coin could be a cryptocurrency that tracks the cost of living. So you can't redeem the cost of living. Like there's no NAV there, but it tracks it and it can only scale by so much because there is a thing that it is not pegged to, but referencing. And so it can deviate too far away from that value because some underlying mechanism will sort of
it's the market, right? So like in a good market design, right, what you're doing is you're making it so if it does deviate, people who bring it back to parity make money. So everything in here is like a market mechanism that's driven by rational, efficient actors like in a market, if that makes sense.
Yes. And you've explained this to me before, and it made a lot of sense, and I forgot it entirely. So Chi is based off of, in some meaningful way, hash, which is a maybe derivative of a way of like compute or energy or cost to mine. And can you re-explain all of this to me?
Yeah. So if you go up a couple slides, actually up, I think it's couple more right there, one down, one that one up. Sorry. Perfect. Yeah, so basically what you're doing is if you look at miners, their sort of cost of producing a hash is largely dominated by energy. So if we issue a token that's proportional to hash, we're issuing a token that's proportional to energy is basically the very simple statement.
Right.
And in the system, what you're trying to do is you're trying to sort of deconvolve all the factors and just get as pure of a representation as energy as possible. So in some ways, you might have heard some people talk about Bitcoin as being energy money, right? But the reason I say it's not energy money is because the amount of Bitcoin in circulation does not represent the total amount of energy that's gone into Bitcoin. There's many factors that go into pricing Bitcoin, stock to flow. Are we near halving? Are we far away from a halving? Utility, speculation, all of those things sort of multiply together. They convolve to create Bitcoin's price, which is no longer than a direct representation of the energy. What we're doing in our system is we're saying a hash is the closest sort of objective reference to energy that we can get. And we even try to deconvolve efficiency of the GPUs. Now, that's an open loop process for us in that we're just sort of projecting efficiency given historical data. But we're basically saying we're very much trying to tokenize the energy portion of that equation independent of all the other factors, independent of utility, independent of speculation, independent of anything. So chi has perfectly elastic quantity of supply, meaning if, more demand happens for chi, the expectation is that the rational actors in the markets will end up creating more chi, such that supply and demand for that are met, and the price is always sort of the production cost. So, but that also then means it has sort of like a perfectly inelastic price, right? So its price is always meant to be sort of that energy price. So then its supply has to be perfectly elastic. So very much different in that way than Bitcoin. But basically we're really trying to use that mining as sort of an oracle or an objective reference to figure out that energy input.
Yeah, Bitcoin's price is not particularly inelastic, and its supply certainly doesn't shrink very often unless someone sends it to the wrong address. And even then, it's not really shrinking. It's like circulating and shrinking. Here, so I think I kind of understand that chi, if, for example, like the price of energy increases, then you would assume that chi supply would decrease. There'd be some mechanism through which it would decrease, so the price would increase to meet the price of hash.
No. So interestingly, if the price of energy were to go up, the market value of chi would also technically go up if we were using like a third reference. So if it was like in dollars, and this always gets confusing, but we'll try here. So the chi is kind of that representation of the energy required to produce a hash. So if the energy required to produce goes up in dollar terms, chi would also go up in dollar terms.
Now, why is that?
Because of how the fact that the cost of producing a chi has now gone up, right? So the referential price point has moved, so to speak, in dollar terms. So the supply will then adjust accordingly until those converge to equilibrium.
Now, see, this was my question. So I was assuming if the price of energy goes up, some chi would be burned or taken out of the supply to force the price to go up or to increase the price.
So that could be one of the outcomes, is that the actual supply, the number of chi goes down while the price goes up. But
is that because it can be redeemed for Quai or? Okay. So I think some gears are turning. Now, so one mechanism of price go up or like reduce supply is redeeming chi for Quai. We can talk about that in a second. What is the other mechanism? Or it seemed like you were hinting that there might be a more organic or natural mechanism for the price going up.
So there's two mechanisms in the system, to be specific. So with chi, the first mechanism is that it's issued proportional to hash. Okay. So what that does is it makes the value of the price of chi in the market, it wants to approach the cost of production.
Right.
From that first mechanism. So if I'm a miner and I can produce chi more cheaply than the price, I'll produce it, thus increasing supply until the market price converges to my production cost.
And if you can't, you wouldn't, because why would you run a negative?
Right. So at some point, you could just sit there and be like, I don't need to mine any more chi because chi isn't profitable mine. So we're in equilibrium. There's the right amount of supply. So at that point, I'll just mine Quai instead of chi. Now,
so does the other choose what they're mining at any given time?
Yes.
Okay, this makes more sense. So the supply rate, or like the increase of the rate of supply, is going to be entirely dependent upon the cost to mine it, which is why chi acts as a flat coin, because it will only be mined when it's profitable or like makes sense to do so, given rational actors in a system.
That's right. So that's mechanism one. Now, mechanism two is if there's too much chi in the world and the market price is below the cost of production, we need to have a mechanism to bring that back up, right? So the second mechanism is there is a protocol offered exchange rate, and it's determined by a controller. And the goal of the controller is to adjust the rate to make the market neutral to the offered rate. Okay? So if the market is neutral to the rate offered, it means that the rate that they're offering in the protocol is equivalent to the external market rate. That makes sense. So anybody can sort of burn chi and mint Quai, or burn Quai and mint chi via that mechanism, which allows the supply of chi to more dynamically expand and contract
without affecting the price directly. So like it's not a buy sell mechanism, it's a min burn mechanism. So you could just burn chi for its market value in Quai, or burn Quai for its market value in chi. This is the market value, not the referential value.
Correct.
Okay. And the reason why you would do that is, let's just say, would it be liquidity constraints would be the reason to do this?
Yeah, well, yeah. So there's two reasons. One is if you have chi, your sort of growth is constrained by the mining rate or the emissions rate. But if I allow you to convert Quai to chi, I can grow the supply of chi more dynamically. Additionally, I can shrink the supply of chi. So if I'm only ever printing chi, but there's, say, like a shock to demand in chi, there's no way to pull that chi out of market without the conversion mechanism. So the conversion mechanism is also the way that the supply of chi shrinks.
So you have these two assets. You have Quai and you have chi. Quai being the proof of work, I could say, like a coin of the entire ecosystem. Chi being the flat coin that is effectively referencing cost of hash or energy. How do these then build out an EVM decentralized financial network?
Good question. So there's one statement, and I do want to go to that slide. Let me see. I think it was 13-ish. This one.
Fully parallel shards and subnets?
Yeah. So one thing that I'll make a statement of is that I don't think any system or economic design is meaningful if it can't scale. And I fundamentally think that is like what has held back crypto, is that you need to be decentralized, you need to be able to scale, and if you can't do that, whatever else you put on top of it is sort of a proof of concept or sort of an MVP. It's not something that can meaningfully like grow and change things. And so this is actually point one. So we have this new architecture, this hierarchy of merchant mind chains, Poem obviously being a big component of how we do that. And so with sort of this ability to go to 50,000 TPS in this sharded subnetted system, Quai is the EVM-compatible token. So it's account-based, it's deflationary because its emissions are proportional to the log of difficulty. So it kind of has this sort of baked-in price rise as the network grows. So that's sort of your EVM-compatible system. So if you want to go risk on, you want to do DeFi, like that's where you go about it. And then chi, is this energy dollar. So the idea here is if you just want to go risk off, you want to, just price goods and services or contracts, chi is a great mechanism for that because it can act as a unit of account. The other thing that chi has is it is actually a UTXO ledger. It is fixed denomination. We enforce address non-reuse per block. And there's two other things that we do if we want to get into those. But the net out is it has cash-like privacy properties. So it's both a unit of account and it's a medium of exchange. So what we've actually built here is a parallel monetary system, which has a store value, a unit of account, and a medium of exchange all in one system.
Okay, so let's unpack that because it's actually kind of interesting. I'd love to hear your thesis on like decentralized finance, why it's important, why we need it. But at the same time, you just said a bunch of things that I want to unpack real quick. One is you said it has cash-like privacy qualities. So like, if I hand my neighbor $20, no one knows except for me and my neighbor unless I tell people. It would not be on some sort of public ledger. People couldn't go and see that transaction. It's effectively there's some degree of privacy in that exchange. Are you saying that Chi to some extent has privacy similar to that, or is it still going to be like public on the ledger? How is it different from like USDC transferring?
So it's going to be very much equivalent to you handing your neighbor a 100%.
Now, how is that?
So basically, when we look at these systems, you have a ledger, so you're still recording things on chain. And if we go back in time, originally people thought Bitcoin was private because it was pseudo-anonymous, meaning you had an account or an address, but it wasn't associated with your name. Ergo, we wouldn't be able to sort of track it. So one thing that sort of gives that away are sats. So the fact that you have sort of 8 decimals of precision, when I spend money with you, how I sort of do that and then get change sort of reveals what I'm spending and what I'm getting change for.
Mhm.
And then that sort of associates all of my addresses and activities together, even if I'm using addresses well. So each one of those outputs becomes like highly fingerprinted or unique. And this is actually sort of how ordinals works in some ways. So Bitcoin, because of sats, is actually more like non-fungible tokens than it is like cash. And you can use that property to sort of de-anonymize the whole chain. So the first thing you have to do is get rid of that fingerprint. And so you do that by creating fixed denominations. Now, if I have a fixed denomination system and I have address reuse, I still haven't gone anywhere. So if you're always sending your change back to like an address and you're sort of reusing that address, everything is still getting reassociated. And if everybody's doing that, you're sort of seeing the graph because people are reusing addresses and you can sort of associate the uses in those addresses. So that's bad, right? So that was the second statement, is that we enforce address non-reuse per block. The reason you can't do it over the whole chain is because it's like an MP hard problem. So you just do it per block. And then what that does is it makes every wallet, if they do sort of the straightforward implementation path, they want to do good address use, meaning they don't want to reuse addresses. So then it makes the system all want to not do address reuse, which then means you've delinked the address problem. So now I've delinked the SAS problem and I've delinked the address problem. Now the only thing that you want to do is you want to make sure that people can't reaggregate. So there's this reaggregation problem in a fixed denomination system where I can break down an output. So I can have like a 10 and I can make 10 ones. But if I were to take 10 ones and then sort of put those back into a 10, I would again be linking all my addresses and any previous activity back together. So one of the other mechanisms is only the first the first transaction of chi in a block can do a reaggregation. So what that incentivizes is people figuring out either to do it via a merchant or to do it cooperatively, because there's a limited amount of reaggregation ability in the system. So what will end up happening is when you sort of get change, you're going to sort of pull all of your change out of your wallet and you're going to be like spend it at a merchant. And then that merchant is going to collect everybody's change for the day and they're going to reaggregate it in one transaction. So what ends up happening is the entropy in this set of fixed denominations is always going up and not down. And then when it does go down, it's technically incentivized to happen in a cooperative way, which actually increases the total net entropy, not decrease it, if that makes sense. So we're not doing any.
Some parts they did, and some part they didn't. I think the heart of the issue initially was if I'm transferring an asset from person A to person B, it seemed like there was something you said that implied that the address of the sender would change or not be reused in a way that would make the sender identifiable. Now, does that happen automatically, or is that just good wallet hygiene?
So since we enforce address non-reuse per block, we
to enforce that. So like effectively from the user standpoint.
So in a block, when we're processing a block, if you try to reuse an address, like the transaction is invalid. So basically, if you want to implement a wallet, the simplest way for you to do it is have good address hygiene. So where it's not perfect, but we're making it so that your default like lowest energy path is to always have wallets with good address hygiene.
Okay, now when you say address hygiene, do you mean like I would send something to someone and then receive in a new wallet, like spin up a new wallet for that? Like continuously have new wallets for new activities?
So we actually use something called BIP47. So you have, I'm forgetting the name, but it's effectively, it's a code. And when we do a transaction, we like share that with each other, which allows us to sort of create a deterministic tree of sort of one-time use addresses for our transaction.
And so let's say
it's actually a known system. It's BIP47. So if you look at, I think Samurai like would use something like this. But basically, if you want to interact with the Chi ledger, because it's fixed denominations, you basically potentially need to always have multiple outputs. And you're not allowed to reuse outputs. So I can't just give you like one address and be like, oh, send me a bunch of things with that one address. Like it won't work. So to functionally use the system, I kind of have to use BIP47. And so we'll exchange these codes. Then you'll be able to sort of derive however many sort of output points you need for a given transaction based off sort of what you have, without having to have like this like back and forth discussion with me in terms of the derivation. So
is that abstracted away from the user? So like if user A sends money to user B, they don't have to spin up 15 different wallets and like play with all these different IPs, right?
yeah, that's right. There's just a wall. So and that's the thing with like accounts versus UTXOs is UTXOs have wallets. So the wallets are technically already doing this with Bitcoin. Mm-hmm. They're doing it in a different way, but they're already technically doing it. So if you actually like opened up your Bitcoin wallet, you would have like this big list of UTXOs, and your wallet, every time you're like deciding to send something, is sort of figuring out how to do it based off the UTXOs you have. So you already have like this set of like many addresses with like many things.
Right. Yeah. So any one given wallet may have a bunch of different addresses for a single seed phrase.
That's right. Right. So you basically have one wallet address code. You mm-hmm. share that with somebody, and then the software figures out how to generate enough and, you know, transmit it correctly and then respend it correctly and all of those things. So you still just see like an aggregate balance, and then behind the scenes, it's doing the work.
And now, is that different from traditional EVMs like Ethereum? Because they also have a bunch of different addresses per account, or is it the same? Or like, what is the thing that makes this more robust?
So in Ethereum, in an account-based system, basically all the transactions you've ever done are on that account. So like if you sent me money, I could then go to Etherscan and sort of like track back everything that you've ever done with that account since the beginning of time. So with UTXOs, if you sent me something, depending on how you sort of manage your addresses in UTXOs, I could do that. It might be a little bit harder, but then if you sort of like sent me fixed denominations, it would, and you didn't reuse addresses, it would become impossible at some point for me to like track what you're doing, you know? And so that's kind of like how Qi works. From a user's perspective, a wallet in Qi looks much like an account in Quai or the EVM. Mm-hmm. So you kind of just have one sort of identifier that sort of identifies that money. So from a user's perspective, they look analogous, but under the hood, they're doing a lot different types of work.
And this brings me to sort of the question that I wanted to get back to, which was, why build this? Why have something that feels more decentralized, that feels more private? What was the driving intent behind all this?
So when I originally got into Bitcoin, what attracted me was sort of the libertarian ideals of Bitcoin, the concept of peer-to-peer digital cash. In that statement, it's separate money from the state. Okay. In the interceding like 10 years, the systems that we have built have stopped doing that. They have become, you know, centralized. They've become trackable. They've become traceable. They've become co-optable because they can't scale. They've become economically unsustainable. There's all these issues with it, but it certainly isn't meeting the goal of separating money from the state. So the whole point of Quai was to build a system that would be capable of doing that. So how do we build a system that can function as money, that can scale, that can't be co-opted, coerced, censored, or owned by anybody? That's truly a decentralized protocol fulfilling that original statement of peer-to-peer digital cash. That was the motivation. That is the motivation. So like, why are we doing all this work? You can't have an independent system if that system can be tracked, because with tracking, you're going to create censorship. So we're basically saying, right, you have to scale, because scale is part of decentralization. That's one thing that like people don't even really consider in a lot of ways, but there's different like levels of security.
Right. If there are 3 miners and they're all you're not sufficiently decentralized.
Well, yeah, and so one thing that's great about Bitcoin is proof of work, and the sort of in a well-designed proof of work system, you have good economic decentralization at sort of the tip of the chain. Mm-hmm. But there's a limit to how much of that you can get. Really, its purpose is to make the system immutable and to finalize transactions so they have security, right? But even with that, there's actually a more robust form of security, and it's actually social. So there's social decentralization if you can get people to use the system. So if you look at sort of the election in the United States and you looked at sort of this anti-crypto army, there's like 30 million sort of Bitcoiners, and they were kind of going against 30 million Bitcoiners or crypto people, whatever you want to call it. But it was on the line of what was politically possible to do without undercutting your ability to get elected. It was like right there. And apparently 30 million was like just enough to sort of defeat sort of the anti-crypto army, I suppose. But if I can make a system that isn't just like some 10 million, 30 million speculators in this financial asset, but I can make it so everybody's using that thing daily, so that they're buying their food with it, they're filling up their gas tank with it. Once you get to that threshold, it becomes impossible politically to shut down. So that degree of social resilience through utility and use is actually where you need to get to if you want to create a system that can withstand sort of attacks and co-ops by the biggest and strongest powers in the world.
Right, because if there's, I mean, people tend not to vote against their own economic incentives. And if the economic incentive is the capacity to participate in the monetary system, people are definitely not going to vote against that, especially if they have any leg up or like potential benefit from the monetary system that they're utilizing. To differentiate you guys from other proof of work chains, not only are you EVM compatible, which is huge, because then all these EVM applications that we're familiar with, your Aves, your compounds, your like Uniswaps, all of those things could be ported over to Quai, right?
Yeah, absolutely. So it's very straightforward too. Yeah.
The other thing I was going to say is Bitcoin does not. People are trying to build it, right? People are trying to build BTC-Fi. They're trying to really make Bitcoin with side chains or pseudo L2s or even like L1s. They're trying to do something on Bitcoin and has had so far a lot of failure to launch, I'd say. There are some things. I think BOB is somewhat interesting. That's like an optimistic roll up. Here, you guys have gone the EVM route with proof of work. You're building out an ecosystem. What is the driver behind wanting to not only be like a proof of work type blockchain and like have the decentralization and have the incentive mechanisms of that, but also be a financialized app chain?
Yeah. So when you look at trying to create a parallel system, what we're cognizant of is we don't want to create points that force people into bad solutions, right? So custodian solutions to bridging solutions to things like this. So if you just created sort of a money system, but you didn't create a finance system that was easily accessible and interoperable, you're going to force people into bad solutions,
right?
You're going to force people into centralized exchanges. You're going to force people into bridges, which are centralized exchanges,
Right. It's like you take your decentralized money and then put in a centralized mechanism. So you've effectively immediately centralized all the assets that you just had.
Right. So one example is with Chi, we like the cash-like privacy properties, but we also said people are going to potentially want to use that in DeFi.
Right.
So there was this question we had, well, should we facilitate that or not? And we said, yes, we should facilitate it, because if we don't facilitate it, you're going to end up with people doing it through a custodian route.
Right. People are going to do it.
So in the protocol, we allow you to wrap Chi, which creates some negative implications on privacy relative to how private your Chi is when you unwrap it. But that trade-off relative to the trade-off of, knowing that people are going to end up having to sort of custodial billions of dollars of Chi and depend on those custodians so that they can participate in finance with it, was a bad trade-off. Right. So we're cognizant of this, and that's also why you want to be EVM compatible. The other reason you want to do it is because you want finance, and if you're looking at the economic resilience of the system, the fees that you can get from doing finance-based transactions are much higher, and that adds to chain security. So in terms of the sort of aggregate design of the system, you want to get as much revenue as possible. You want to service as many use cases as possible so that you have the highest degree of economic security and resilience as possible. So you can't just be cash. You got to be all these things if you want to have a shot at creating a truly parallel system. And you can work out the numbers, right? Like I think Bitcoin is maybe doing 60 million a day in payments to miners. And then if you sort of look at sort of the attack surface, like Bitcoin, if the government wanted to, it could still be attacked. So you actually have to get at least an order of magnitude higher than Bitcoin before you would say you're out of the economic attack zone of the nation state, or at least beginning to be. And you're not going to be able to do that on transaction fees that don't involve finance, because what ends up happening with finance, and
does that take liquidity into account? Because I mean, sure, like at a given price, theoretically it could be purchased, but it couldn't actually be purchased.
You mean in terms of like hash rate?
Well, I assume like for a nation state to attack Bitcoin. Oh, sorry, it's not proof of stake. Wouldn't need it. It would just need to. Yeah, it would be through miners, not through.
Well. I'll give you a very interesting situation with proof of stake. The way that a nation state attacks proof of stake miners is regulatorily. Mm-hmm. So if you look at where a lot of the sort of staked tokens are, a lot of them are in sexes, right? And those centralized exchanges have their business is effectively predicated on having access to the U.S. banking system. So if the Treasury went to those people and said, hey, if you want to maintain your banking license and you're also staking all this, ETH, maybe for example, as a validator, we no longer want you to process transactions from any of these OFAC sanctioned addresses. So not just process, but don't even process on top of blocks that are including those types of transactions. At some point, there's enough pull because of how that system is structured that effectively the Treasury, via regulation, could control the outcome of a protocol, right? So,
wouldn't it get slashed?
Well, see, this is the interesting thing: is if you were to create a fork, you would do it in such a way that it wouldn't create a valid signature against the thing you're forking out of. So you always have a nothing at stake problem for the stakers, because then every staker is going to go off into this protocol, which has exactly like one byte changed in the encoding scheme of how they're doing the blocks or the signatures. And the original protocol doesn't see it because it's one byte different. Now, all then stakers are then incentivized to actually continue staking on both systems if they think they have a chance of winning that's above their cost of just operating the divergent nodes. So the concept of slashing doesn't actually like make any sense if you think about how you would design a fork in the system. You would literally just wiggle one byte, and then the other protocol is completely unaware that it exists.
Okay, well let's circle back to.
But that's materially different in proof of work, right? So in proof of work, because we're making like this fixed commitment, that's much harder to do, because you basically have to commit to A or you have to commit to B. You can't simultaneously commit to both. And that's like a very historic problem that I don't think ever really got fully answered by the proof of stake people, but it's known as the nothing at stake problem. Yeah.
We could probably spend another half an hour just dissecting that one very niche issue, and I would love to, but I do want to ask you let's see. The big question I have is, what is going on Quai? Like, what is the future? Where are you guys moving towards in your immediacy?
Yeah, so there's a lot of sort of the first like level, right? I think of these things in like levels, right? So the first level is, you have a network running, and you can start to get access to the token via mining or via exchanges. This is kind of like what I would call like the monetary level. And then once you get to the monetary level, then you get sort of to the application level, right? And your basic applications are going to be sort of your one order derivatives, like your swaps, your tokens, your ERCs, things like Akash, Fast, and Chlor, etc. And there's multiple pages to this too, if you want to go through it. But people have been building, there's like games, a couple games on Quai. There's these swap services like Quai Swap and Ice Cream Swap. There's token services. There's something called Poop.fun. It's a clone of Pump.fun, if you will. Very fun. It's actually got a killer color scheme too, if you want to go to it. But yeah, if you scroll, or maybe go to, there you go.
There you go.
Very, very retro. And there's also some sound Easter eggs in here too. When you mint or sell a token, there's sound effects. It's pretty funny. But when you're looking at Quai, like one of the reasons that that is because meme coins are shitters, obviously, and I think it's good not to take them too seriously. Oh, Portal's on here as well. Oh, marketplaces. We have some good NFT marketplaces. Quai is pretty great. There's a number of.
Are there? So I know like there are some narratives where chains are trying to bootstrap their ecosystem, and they'll have like incentives, or they'll have some mechanism through which they bring on new users. Are you guys doing any incentives, or do you plan on doing any sort of?
Yeah, so we have a grants program for builders. So builders can come in, they can build projects, they can put applications in for grants and get Quai that way. When the liquid mining tokens come online, that's going to be a big incentive for capital to come into the system, because up to 25% sort of APY is pretty good.
Yeah, and also theoretically, if liquid mining happens, there will potentially be a governance token for that liquid mining protocol, which may additionally incentivize usage of that. What do you call it? MT, liquid mining token?
Yeah.
Nice. And then if there is a liquid mining token, of course, then you have leverage and looping, which just it becomes a TVL sync for users who are interested.
Well, what's really interesting is as enough supply of chi comes online, that yield becomes available in chi.
I was going to ask that too, because if you can choose your reward for mining, then an LMT could be a Quai LMT and sort of have more variable price, more elastic price, or it could be a Chi LMT, which has more inelastic price, but also maybe a similar yield.
That's right. So you're kind of creating, quote unquote, a stable yielding asset, which is pretty cool.
And then you could also delta hedge if you want to by like shorting energy stock. I mean, there are ways to speculate and hedge your volatility if you wanted to, while also leveraging and looping yield. Okay, so I know we went way over what I expected to do because it's just so fascinating. In the last few moments, what am I missing? What else should people know about Quai as a takeaway?
Yeah, I think the summary of Quai is crypto started with the goal of separating the money from the state. Between the idea, research, and full-time development, I've spent 7 years prior to going to market. And the reason that I did that is because I wanted to build a system that could fulfill the original mission. So everything about Quai is meant to create a system which allows you to defect from the current monetary system and never go back. You have your risk on assets, you have your risk off assets, you have your privacy, you have your EVM compatibility. You effectively have everything in one system that is meant to be decentralized enough to resist eventually nation state level attacks. So if you're looking for, the thing that is fulfilling that mission, this is what I built it for. So that's kind of the takeaway in my book. There's obviously a lot of opportunities if you're not quite that libertarian in degen. That's a new ecosystem, a scalable, EVM compatible, yields on both risk on assets with Quai and risk off assets with Chi. And great opportunity, because in new ecosystems there's always good opportunity to sort of get that pole position for different applications. So a lot going on.
Is how do people get onto Quai? So it's EVM compatible. Presumably there's some sort of bridge here. What is the flow from like, okay, I'm on Ethereum. Ethereum doesn't feel like it's sufficiently decentralized libertarian anymore. I want to go to Quai. How do I do that?
Yeah, so the simplest way right now would be via Gate or MEXC.
Mm-hmm.
There was a bridge, but it had some issues within its bridging ecosystem, so the liquidity isn't there anymore. We're in the process of getting another bridge integrated, so hopefully that will be online soon. But sort of our original bridge had some issues. So
in the interim, you can purchase presumably Quai on Gate or MEXC, bring it over, and then start participating in the ecosystem that way.
Yep. Or you can use one of those turnkey one-click clients, and you can mine it if that's your fancy too, right? You can use your ETH to buy some hash rate and turn it into Quai.
Yeah, and that would be quite a fascinating. I mean, it'll be neat to see the arbitrage between cost to mine and value of mining and see how that scales. Well, thank you, Dr. K, so much for joining me today. It was a pleasure, and it's always fun to talk to you. And if people want to follow you or Quai or ask questions, where should they go? What should they do?
Yeah, so my handle on Twitter is Mechanical K, spelled Kalk at the end. You can also follow Quai Network on Twitter. And then you can hop in our Discords, which you can find links to from qu.ai is our website. We have sort of the general Discord, and we also have a developer Discord. If you're looking for grants or development help, I would go into the Quai developer Discord. But those are all ways to get in touch with us.
Fantastic. It's good to see people still fighting the good fight on the decentralization front. Thank you for watching. Thank you for joining us, and everyone else, have a wonderful rest of your day.